Hello everyone, this is Chris. Welcome back to my channel. So today we're going to keep working on the financial model for the tax equity part. In the previous class, we give you guys some background about the tax equity, about the scheme, and how U.S. government to develop the renewable energy sector. And let's see how we're going to translate that into the financial modeling. So in the last class, we end up with the EBITDA. And for this modeling task, we don't need to build up the three financial statement. So we directly get into the cash flow calculation, see about the valuation. So we name it as tax equity part. And before that, we want to do some pre-tax analysis about the valuation, see what would be the original cake for this project. So that is in terms of the project IRR. So the capex we're having is let me see, it's 1.05, and we're also having a seller proposed margin, and the seller is proposing a $0.2 per watt margin. So the total acquisition price, which is in form of the EV at cash-free, debt-free basis, that will be equals to $1.25 per watt. We'll keep that. And then the total acquisition price in terms of the total amount will be equals to $25 million US. So that's the total EV at cash-free, debt-free basis, and that will be the total use of fund. And then we have the use of fund, and we will need to figure out the source of fund. Let's see how we break that. But before that, we want to see the project IRR pre-tax. So let's do a valuation, which is pre-tax part here. You have the acquisition price, which shall be equals to your 25 million, and when we invest that, should be here. So when the project is under construction, you want to dive into the acquisition. That is how the U.S. government defined. You have to dive into get into the construction, get into the project during the construction period, so that you can secure the ITC. So we put it here, and we're having an EBITDA. Your EBITDA will be equals to here. And then you should have a cash flow for IRR calculation. We can just simply name it project cash flow pre-tax. And you're gonna have an IRR, project IRR pre-tax, PIRR pre-tax. So it's roughly about like 5.7, because all our analysis needs to be pre-tax. We can definitely spend some time to calculate the post-tax IRR, but let's just focusing on the tax equity part. So that's a very simple valuation, and then we will see how the sponsor and how the tax equity investor split those profit and the cash. So, and always the same practice, we build up the timetable, the flag table, or the flag. So we are having a start of the pre-flip period. Pre-flip period, and end of pre-flip period. Remember, for the pre and the post-flip, we're gonna have a disproportionate allocation based on different percentage to the tax equity investor as well as to the sponsor. The disproportionate allocation is gonna be applied in the cash flow as well as the P&L income. So the start of the pre-flip period, that's gonna be your, basically that's your PPA period. And we'll see, we're gonna have a 6 years pre-flip period, and that is time based. So you're gonna have a 6 years. You're gonna multiply with the months per year minus 1. You get 6 years since 2024 January 1st, and sorry. So basically the same rule. And just quickly recap, you're not necessarily going to use all the time flags here, just maintain the same practice. Keep the same format, and then that will be easy for you. Just copy paste all your formulas. So that's very simple. So 6 years pre-flip period, okay? And then you're gonna have what? You're gonna have a post-flip period. I'll just do that manually. You start of the post-flip period is the end of pre-flip period plus 1. And the end of post-flip will be just all the way to the end of the projects. Oops. Same rule. And same formula here. Okay, have a quick check. So that's the time flag. And then we want to see, we want to build up the ITC part. Before we do the calculation for the tax equity investor and also the sponsor, we will need to have the figures about the ITC, the income, as well as the cash flow, which is going to be the EBITDA. So let's see the ITC part. So your ITC eligibility, you're gonna have a 30% amount of your total eligible capex. So your total, your fair market value. Be careful, here is there is a fair market value. So the ITC amount is going to be calculated based on the fair market value. Otherwise, there's a way to manipulate the ITC, right? So that's the unit price, and your total amount going to be equal the same method. You times the 20 megawatts, you times 1,000. So your fair market value of this project is 27 million. So your ITC amount gonna be equals to 30%. The total fair market value with the 95% eligibility that can be applied for the ITC calculation, and you times 30%. So you got 7.7 million amount of US dollar for the ITC. And let's assume that can be 100% enjoyed by the tax equity investor. So that's the ITC amount. And also another thing is there is a depreciation deduction. Means that 50%, there's a 50% depreciation deduction from the ITC. That's another rule, means that you're based on your ITC, because you already claimed the ITC, you know, based on the total fair market value, and that's actually should be a deduction in your PP&E, and 50% going to be, you know, that is given by the questions. So it means that your PP&E basis shall be equals to your total acquisition price minus the deduction. So 21 million US dollar going to be your depreciation basis. And let's see the depreciation. I think in here part I missed one line. So you're gonna have a project A depreciation, because that's a dynamic part. I will just simply put a link here. So in total, that's 100%, and that should be careful with the format. If it's linked, then that's great. So your depreciation shall be equals to this figure times the base so that's in total 21 million PP&E base. That's the depreciation. So then you're having the ITC, you're having the you have the depreciation, you have the EBITDA. It means that you should have the earning before tax, or a taxable income, which is the income that shall be used for the allocation. So let's see. Let's put that all together here. So you're gonna have ITC. Your ITC amount gonna be happen in the start of the flip. And your income, no, let me put the, okay, I think I can put the income here. So income will be equals to the EBITDA, EBITDA here, and minus the depreciation. So as you can see, that's it's more like in the first, it's not 6 years. In the first 5 years, you're gonna have a lose, and then in the 6th year, you're gonna have a profit. Means that you're gonna have a taxable CIT payable, and then you have a EBITDA. It's all at 100% basis. So the work we will need to do afterwards is to see, so those 3 items together is the overall cake, and then we will need to do the calculation. We need to figure out how the tax equity investor and the sponsor to split those 3 items. So the questions didn't require us to do the calculation for the tax equity investor, but let's do that. So what's the income? Let's assume before the flip, during the pre-flip period, 100% of the income going to be allocated to the equity investor, and 0% going to be applied after the flip, or we can use 1 minus 100%. So it's 100%. You times the income here, which is negative, and you need to times the time flag here, and also you will need to plus the post flip times the income here, and you times the post flip structure here. So it's going to be all the same method. So that's the income, and then based on the income, you can have a tax. We can term it as a tax equivalent cash flow. I'm not sure if my not sure if the spell of the equivalent is correct. Anyway, I'll just put it here. And so here is just a pure input. The task that didn't require us to put that, but let's we can simply put that here to see. So for the tax equity investor, those gonna be their tax equivalent, the cash flow. As you can see, we use the 21%, which is the CIT rate in US, times the taxable income, which is a loss that can somehow playing as a tax shield in the investor's overall P&L. So that's going to be like a cash flow. So that's the tax equivalent. And then we can see what would be the investment amount for the tax equity. We term it as a TE. We'll put it here, and here I have missed. Actually, put it there. So there's a tax equity syndication rate. TE syndication rate is 1.2. It's like a multiple. So it means that you will need to invest on the actual equity or actual cash at 1.2 times of your ITC amount. So that will be a negative cash out, and that will be incurred during the construction period. So let's see, the ITC amount is this, and we'll need to put that. Let's put that here. So in the very beginning, you're gonna have the tax equity investor will needs to invest 9.2 million US dollars to for the projects to complete the acquisition, okay? And then you're gonna have what you're gonna have. You're gonna have ITC, okay? ITC when you're gonna incur. ITC gonna incur in the very first year of the project operation. I'm assuming it's gonna be incur. So in the second year, you are recouping, 7.6 million, 7.7 million US dollars from the ITC as the investor, and we're assuming that they can enjoy 100% of the ITC, or we can simply put a percentage here. So we times the 100%. So that's the ITC, and let's have a EBITDA part. So here's a bit of tricky. Normally, in the U.S. market, they're going to be like a 20% or 15% cash flow distributed to the investor, to the tax equity investor. However, in our case, there is a 2% preferred return, which the 2% is based on the invested capital from the tax equity. So it's 2%. So for each period, you're gonna receive a 2% cash flow based on your equity investment. Maybe I should use that here. So, and that should be a positive figure. Oops, sorry. And that happens during the pre-flip period. Okay. I actually should know. So that's your operating cash flow, or we can term it as operating cash flow. And remember one thing, there is going to be a call option that sponsor are going to be applied when there's the flip. So it means that the sponsor going to buy out all the shares of the projects from the tax equity investor when 6 years has been passed. So for the TE investor, they're going to receive a price. So is a selling price based on call option. Let's see, the call option price will be equals to 10% of the TE investment. So let's have an airlock here, and when it's gonna happen? It's gonna happen at the end of the pre-flip period. Oops. Let's see, and it should be positive figure, right? It's going to be a cash inflow for TE investor. So let me see if I've missed anything. So a cash flow pre-tax. When we talk about pre-tax, the pre-tax is without considering the tax equivalent cash flow, but we do consider the ITC, and also we didn't consider the CIT going to be applied in the TE balance sheet or P&L. So let's see. So we sorry. This should be your. So that should be like that, right? Okay. They're gonna have a extremely high IRR. Let's see. The question didn't require us to do the IRR calculation, but let's have a quick look on that. So this is seems pretty low for the tax equity investor. You're gonna have a 3.07% IR. I think something is incorrect. Oh. I think it's correct. Anyway. It's 1.2 times, and here you're gonna have a 10%. You're gonna have that. I think that's correct. Let me just simply put that here, and I will do the calculation for the sponsor. And here is the tax equity investor. For the sponsor, just the same rule, and we'll need to split the ITC income and the EBITDA, and also the investment amount, and see how it is structured. So for the income part, before flip, that's gonna be 0%, and after flip, that's gonna be. So I think that's better to put a pre-flip, post-flip. So that is how they split the cash and split the income. And also I can simply using the total income here minus the income already distributed to the tax T investor, and let's see. Anyway, for the sponsor, we don't necessarily need to calculate the income tax income allocation here, because we are not going to perform a post-tax analysis. Just show you guys how to do the calculation here, and then we can have a tax equivalent cash flow for this part, 21%, and so here, in reality, for the sponsor, if they own the projects all the way to the end of the projects from year number 7, they're gonna pay tax. In reality, not at the project level, not at the SPV level, but at their own balance, the P&L. Okay, that's and then we can have the investment amount. The investment amount gonna be equals to the total amount, which is 25 million, now 27 million, that's the fair market value, minus the amount the tax equity investor already invested, which should be here. And this amount is happened during the construction period. You're gonna also have the, let me see, the ITC, which is in this case is 0. But normally in some real case, it's going to be a 99% against the 1% from for TE investor and sponsor. You have the ITC and then you have the operating cash flow. For the operating cash flow, you just use the 100% EBITDA, EBITDA minus the EBITDA redistributed to the TE investor. So that's your EBITDA or operating cash flow pre-tax. I think, and there's also selling price, or we can co-option price, which is named as price or buyback price, whatever it is. So that can be equals to the opposite amount from the T investor perspective. So that's the thing. So then you're gonna have a cash flow pre-tax from the sponsor perspective. What are you gonna have? You're gonna have okay, you can starting from here. And then you can have IRR. So you have a 9.2% IRR, 9.2% IRR at the project level pre-tax. That is, I will also need to name it as unlevered. So remember, we're having a hurdle rate for at the project level. I think I somehow put that here. No. Okay. Okay, I think it's in the slides. We're having a WACC, or weighted average cost of capital, at 8%. So right now we're having a 9.2%. So which seems reasonable for us to do the calculation. And also for the tax equity part, maybe let me check. Or the post tax, it means that let's consider the tax equivalent part. We plus the tax equivalent cash flow and see what we have. We're having like that, and then we're having a 17.97% of the IRR for the tax equity investor. It means that if the tax equity investor can quickly monetize all the losses or the ITCs, this is going to be a profitable project for them participate in. And also, if we see what will be the post-tax unlevered, it means that let's do this plus with the minus of the tax. Oops. We're having 7.7%. So because for this question, for this modeling test, it is required us to do the valuation all pre-tax analysis for the sponsor. So here is the answer we want to submit to the recruiter. And for here, we can do the calculation. If you think the 3.07%, sometimes you think is irrelevant or uncomfortable, you can simply just hide that or delete that. That should be okay. So that's the overall part of this class. I think it's very straightforward, but one element I would like to highlight is not yet done. We will need to do the portfolio analysis, and also at the same time, we will need to consider the financing. Until now, what we're having is a levered return, and we will need to consider a back leverage financing at the sponsor's opco level, see how it works. So that'll be all for this class. Thanks.